This is the Real Estate Interview, the Real Deal series of in-depth conversations with people making a dent in the real estate business. I'm your host, Hiten Samtani, and today I'm joined by Casey Berman of Camber Creek. Casey's the co-founder and managing partner of the firm. It's a VC firm that focuses on the real estate tech space. Camber Creek has backed the likes of VTS, CompStack, 42 Floors, Y Hotels, and Latch as well, and so many more. So we're going to talk about the changing real estate tech landscape. We're going to talk about COVID as some sort of a BCAD point in terms of investing in real estate tech, and a lot more. So Casey, thanks for being with The Real Deal.
Yeah, thanks for having me today. Excited to talk about real estate tech. I like how you said the BCAD. That's a great metaphor. Another way we've been thinking about it is the Great Extinction. You could no longer be a dinosaur. You had to have this real estate tech-enabled experience for your consumer in almost every asset class. So Latch is a great example. They were positioned perfectly for COVID. They provided a fully touchless experience in a multifamily apartment. You did not have to have a key fob or a touch code for the door. You had your phone, and your personal phone could provide the access to all of the building, the entryways, your own personal space. You could text a key code to your dog walker, to whoever it might be. You could do everything touchless. And by having that functionality prior to COVID, they were perfectly positioned to then capitalize on what became a need to have. Pre-COVID, the Latch product was a nice to have and excellent for premium buildings. Now, today, it doesn't have to be a premium building. It just has to be any building where they want a touchless experience. And that's exciting for us to see this whole industry transition to the future.
Right. And there's so many second order effects, right? With something like, let's say with Latch, there's less time that the showing agent or the on-site manager has to be with the potential client. There's less in terms of like duplicating keys and many other sort
changing out a cylinder. All the headaches of the traditional building engineer are as simple as just using the software. That's the little things add up to a lot.
Yeah. And what about on the commercial side,
So one of the things that just has dramatically shifted across our entire industry is this recognition of environmental, social, and governance issues, so ESG. And we had seen this as this massive trend that was coming back in 2017. And today, it is a requirement. From the institutions down to the sponsors and the real estate tech companies now, every group needs to be both cognizant of their own company's ESG footprint and priorities and procedures, and all of their stakeholders, all the groups that they work with. So one thing to just ignore it. That's how we were before. Now it's tracking it. We need to track it. And then the second piece that we've also seen a massive adoption is benchmarking. One of our portfolio companies, Measurabl, is the leader in that space of both tracking and benchmarking each of those categories.
So what is that like with Measurabl? What are they looking at? Because one of the things that's been tricky, right, is that in real estate as it stands, asset level measurement is really poor, right? Which is why you have these laws like Local Law 97 in New York, which is kind of a blunt instrument. It's like buildings, a sewing machine enterprise in my building versus having like a Palantir or something like that. The energy usage is so dramatically different.
So first, I really want to see your sewing machine tenant. I'd love to see that. Second, with the actual asset measurement, one of the key pieces with Measurabl is the ability to implement massive portfolios and benchmark them really simply. To your point, one of the biggest barriers or friction points with adoption in real estate tech is implementation. And that was from day one of the key challenges that Matt and his team solved was in order to get groups to adopt and benchmark implementation, and not just one really, terrible building that was built in the 70s and has a terrible EMS and BMS system. It needs to be any building could be implemented incredibly fast, and more importantly, the whole portfolio. So if the actual tracking of that building is even easier on Measurabl, and even easier than having a person like procure the supply contracts for those utilities. Then they're going to switch because it's easier than how they were currently doing their existing job, and they can do a lot more. So one of the things we're looking at, and we've made investments to, is then that next step. You invested in a company where you can then procure power.
Okay.
You can take it to the next level. So first benchmark, then procure power. Actually do it differently, change your behavior. And if you have a benchmark that enables you to make change and make an educated decision on what you're going to change. So I can benchmark across my entire portfolio and bring the entire portfolio to a higher level, so that when I talk to a public pension or institution who has these very high requirements, I satisfy them. And not only do I satisfy them, but I can show them on a regular basis how strong I am relative to all the other potential sponsors in the market. So there's this incredible wave of positive reinforcement happening with both the capital providers and the sponsors.
And I want to get a sense of how you kind of deploy money in terms of making, let's say you find a startup that does one thing extremely well, whatever it is, right? What they measure buildings, or they
make sewing machines. Let's go back to your example.
Or make sewing machines, one thing really well. That let's just call that a service bet, right? And then the other one is what I would call, let's say, a platform bet, where you bet on a startup that right now might do one thing, but you could probably see it sort of become an OS or an integrated platform for multiple services, not only theirs, but maybe APIs for other services as well. So I guess, do you think about those distinctions, and how do you sort of allocate your capital based on those bets? There's a few companies of yours that a few companies that you've backed that I would say fall into the platform category, and then there's others that are just extremely good at one thing. So how do you make that distinction?
Yeah, I love that you are making the distinction. You know, a lot of people see just real estate tech investing as, just here's money. We make a very big distinction. And the way we describe it is there are niche companies and platform companies, and they are very different. So the way we view a niche company, it solves a very specific problem, quite often in a narrow asset class. So multifamily is a huge asset class, but narrow in the scheme of all real estate. And there are very specific problems that need to be solved for owners and operators in multifamily. We would define solving one of those as a niche. And for us, a small portion of our portfolio is made up of companies that fall into that niche category. The benefit we have with the niche is we have this built-in massive network of customers. We can take a very small niche company, make it large, and then help it grow into a platform or be bought by a platform. A good example, one of the most niche companies, is a company called Pet Screening. They solve the service animal liability in the multifamily space. So with Pet Screening, they provide a multifamily owner or operator the ability to screen service animals without the liability. If you ask a potential resident, why do you need that service animal? What is your disability? That is cause for a lawsuit.
That's almost like asking someone in a job interview, are you married? How old are you? So that's all right.
Exactly. So by having pet screening within your application process, it manages all of the liability of a traditional pet. It also manages the liability of the service animal. So what we have found, it solved a very specific problem. A massive portion of our LP network can use it, which helped the company grow very quickly. And it's become one of the industry norms. So for us, a small portion of our portfolio is dedicated to these niche type companies. And then as another example, a company called Latch that we talked about earlier. Latch is not only an access control company, but they have this past fall launched their operating system. Where for a resident, through this one app, you can work with your thermostat, you can communicate with your landlord, you can give people access to your building, And as Latch integrates with more and more solutions, you can live and engage with your physical building more and more through this one app. We view the Latch OS as this 2.0 of PropTech.
Mm-hmm.
And that is, people don't want 8 different apps to do things in their apartment building. They want one.
Yep.
You go into your apartment app, you open your door, you mess with the lights or the thermostat, you can communicate about the package, you can let someone, you want one experience.
Right. And I think to that point, Casey, Latch's core service or its first service already solved what I would call maybe the highest trust barrier, right? It already
Right.
Opening
Exactly.
your apartment is the highest trust you're providing a software, right? I'd give control of my fridge over to software very easily, but letting someone in is the highest thing. So once you already solve kind of the highest thing, then you're going for lower trust interactions, which is easier, right?
Yeah.
In a way.
And it's easier. And for the most part, the door access has the highest engagement.
Mm-hmm.
One of the things we look at with every company is what is the engagement with the customer? The exciting thing for us was Latch already had the highest engagement of any app in an apartment building with just the access control. So now to build on top of that, these other solutions, it's just all additive. Mm-hmm. And they become the focal point of the building. Historically, it was just Yardi, MRI, Entrata, and RealPage. Because they had the accounting, because they had the rent payment, those were your only options for your core resident or office tenant landlord interaction. With Latch, it's a whole new game. Mm-hmm. There's this whole new opportunity to interact. That's what they've started with this Latch OS tool. Mm-hmm. And we view this happening broadly. We, the consumer, are so used to having what we want, not only where we want it, but when we want it. Mm-hmm. And the cell phone unlocked, use your cell phone right then and get it right when you want it. That is now being translated into real estate. And Latch is a great example. But see this
with residential, I can see the pressure coming somewhat from the tenant as well, right? If you're a tenant with options, which means money, those are going to be some of the defining factors. But in the office environment, there's been sort of the tolerance for crap is a lot higher, right? So far. Do you see that changing at all? I know you're invested in 2 companies that I know well, VTS and Building Engines, which also owns RDM. But talk about the office environment in terms of, is there any pressure to change the way that the tenant interacts with the building? Yeah.
So the biggest pressure points come really from a renewal. Right? When you have a 5-year office or even 10-year office lease, you don't have much leverage as the tenant. Mm-hmm. And what we are seeing for the past 10 years, there's been a significant amount of pressure on landlords to provide better service, to provide engagement, better engaged communities, so that the tenants could provide a better experience for their employees. And what we're seeing with COVID is a massive acceleration. Mm-hmm. And there's pressure from 2 places. The first is there's this unknown of whether or how much demand there's going to be for traditional office space. So that's the first piece of pressure for the office landlords. The second piece has been this slow, intrinsic, built-in rental pressure, just rent prices in the office market. So between the 2 of those, we're seeing a significant amount of change with what the landlords are offering. You mentioned a great example with Building Engines. Building Engines went from just a back of house in the language of hospitality, back of house property management tool for the building engineers, for the property manager. And now they have a full suite of tools, not only for back of house, but for the tenant as well. For the tenant to engage, for the tenant with the landlord to the tenant to engage with the actual physical space. And all of the subcontractors. So to your point, it is becoming the real estate 2.0 in the office space. Similarly with VTS. In the office market, just knowing in the transparency of what is out there, for the past 10 years, there's just been one company, CoStar, and then LoopNet, which got absorbed by CoStar. And having an awareness of, number one, what is out there, And then two, understanding and being able to communicate with the landlord, that is a new expectation. And the past year with COVID, we think there's going to be a massive demand for flexibility, whether that is, a combination of you have your core headquarters, which is your own space, you have access to some quantity of shared workspace within the building. And then the last category is a software solution to enable you to actually use space either in a third-party location or enable your employees to work from home.
Can you give me sort of the dream scenario on the office front? Like, let's say your investments really sort of pay off and the companies evolve in the sort of the dream scenario. So I want to understand what the office building experience could look like in 2030 based on that.
Yeah. So the perspective we take of the dream office is from the employee.
Okay.
Ultimately, the consumer of the office space is the employee who historically had no say. The CEO or the senior team picked the office space because it was relatively close to their house or relatively close to where they wanted it to be. They locked in for 5 and 10 years. Then everybody else had to make do. So the way we think about it and the lens we're using is from the employee perspective. And the key driver 10, 15, 20 years from now, the way we see it is flexibility. The organizations that enable and, taking it a step further, empower their employees to have flexibility with how they work are going to be the best employers. They're going to recruit the best talent and they're going to have the best employees. So the way we see it is flexibility, number one, and empowerment, number two. And what does that look like through our eyes is, how do you empower your employee to work from home some days, to work in a co-working or it doesn't have to be one company, but just a shared space another day. And
I love this thing about looking at it from the lens of the employee and kind of mapping out your bets like that. Right now, there's been so much talk about sort of the empowerment of the employee. The employee is going to call the shots. The employee has sort of the access to every, it's really a war for talent more than anything else. Do you think that even in a different economic cycle, that would still apply? Like that is.
And the most innovative companies, the companies that are going to have the best talent over the long term, will be changed the most right now. And that's this idea of complete flexibility. So it's exciting for us. I mean, we view it as change equaling a massive increase and a massive opportunity to create value through the growth of companies.
Right.
And
so Latch is, I believe, going public through a SPAC with Tishman Speyer. Tishman Speyer is a sponsor of that SPAC. And I'm sure, so SPACs have essentially become a quicker exit for a lot of investors, including you guys.
Yeah.
But now there's been some scrutiny from the SEC. They're going to evaluate, for example, how warrants are looked at. They're also going to take a little more of a closer look at forward-looking statements and growth projections so that someone can't say, oh yeah, we're at 1 million revenue, we're going to be at 90 million in 3 months, right? How do you think some of these changes would affect the broader SPAC landscape and then what you guys do?
Yeah, so the SPAC landscape really created a new outlet at the growth and pre-IPO stage. So let's, back into your question with that. By adding a new outlet, by adding really increased liquidity, there's a larger supply of capital. And the number of companies did not go up in line with how much SPAC capital there was. So what we've actually been seeing in the later stages is the increase in prices. That's very similar to the increase in prices just in the overall public markets. So the question is really around the SPAC. And more scrutiny in our mind is a positive thing. And the reason why we say that is there is a balanced amount of SPAC capital that is productive for the market. It's not like the SPAC is the only way to go public, right? You can do an IPO.
But if all the companies that are in this space I can think of Compass is probably the only company that took the IPO route recently, whereas there have been at least like 9 or 10 companies that have gone the SPAC route, right?
Right.
And
One of the
like,
things that we've been both with our portfolio companies, including Latch, is cautioning around making sure there are 3 pillars for their company. Number one, governance. They need to have an incredibly strong governance in place so that when they are public, they can hold to the scrutiny of a publicly traded company. That is very different than a privately traded company. Number two, they need a foundation of customers. What we've seen and where we've seen SPACs fail is where they do have a base of customers that is not strong enough. They do provide forward-looking statements that are too aggressive. And then after it is public, both the price and the company start to falter based on this faltering of these core foundation customers. And those 2 are critical. The last piece for those 2 are critical for really any public company. The last piece is relevant to the SPAC space. You need a sponsor that has a long-term vision that aligns with the company. And that is because the public markets are totally unforgiving, and there needs to be a long-term plan. So an example with Latch again is Tishman Speyer has been a leader in both the real estate space, real estate tech space, and even more precisely in the operating system for a building space. So they launched this long-term alignment, the long-term thinking, the long-term way of creating value for its shareholders has us extremely excited about that SPAC. With certain other sponsors and other SPACs, we are very concerned and almost like we want to make sure that it doesn't hurt the overall industry. One of our bigger fears is just the overall SPAC market hurting specific companies that are doing exceptionally well.
And then when you look at the landscape, I have 2 questions. Maybe I'll start with the real estate one. When you look at the landscape for PropTech, a word that probably didn't even exist when you guys started, now there was this movement 2 or 3 years ago with a lot of real estate owner operators, very well capitalized, obviously have the contacts and connections. There was this sort of move to play investor a little bit. There was a move to sort of play VC a little bit. I know RXR did some stuff, Milstein Properties did some stuff. That sort of died down a little bit. Like there's a distinction again, or they're coming back to, I guess, what you guys would be a professional investor, right? As opposed to a side hustle investing. Yeah. What's your thought on that? What was your thought on like sort of the owner operators who knew the space, who obviously have a lot of capital getting in, and now there seems to be a bit of a retraction?
Yeah, I mean, I think your analysis is spot on. And what we've seen to succeed is, you nailed it, professional investing. Side hustles, one-offs, bets don't work. Like just intrinsically, those don't work in this space. We, within Camber Creek, we actually never even use the word bet. For us, everything is an investment. And we run companies through our beta lab. We actually try them out with our LPs. And not only one company, but we'll try out a company and its 3 closest competitors. And it's that systematic approach by not just like, this one came across my desk and it's really cool. Here's money. It's this one came across my desk and we're already tracking the 3 other competitors. Let's pick the best one of these 4. By doing prop tech investing professionally, you can invest in the best companies over a long period of time. You can then spend the necessary time and effort to help them grow. I mean,
the second point is PropTech is no longer that niche, right? It's quite a significant sector in terms of investing. You're starting to see some of the bigger names with a lot more capacity to write bigger checks than you guys or anyone else in the space. For a long time, Camber Creek, Fifth Wall, Metaprop, etc., sort of had this incredibly large asset class to themselves. right?
Yeah.
There was this like, you're looking at it, I don't even know from your perspective, but it must have been like, wow, this is $1 trillion opportunity and no one's looked at it. That's no
Yeah.
longer the case. Now you do have some of the generalist, sort of the big boy funds coming in, and they're able to write different kinds of checks. They have a brand recognition that is, broader, even more global. How do you compete? How do you differentiate? And how do you make sure that you get the best deals when someone like, I don't know, Sequoia, Andreessen, et cetera, is now looking at the space?
Yeah, I love that question. And it really plays into our favorite part of the business, our biggest strength. Number one, we add value. And in venture capital, I will say every single company, every single partner will say they add value. Uh, our first move with a potential company is to add value and not say it, but do it. So when we start talking to companies about investing in their company, the first step we make as after we've engaged in due diligence is introducing them to customers. Mm-hmm. And that is unique. Actually put that forward where if we don't do a deal, we will not see any benefit directly by putting in that value. We take that first step forward. We don't say, hey, we need to have like a special arrangement, or we're going to charge you a consulting fee, or some type of warrant structure. We don't do that. Mm-hmm. We say, we're going to be a long-term partner. We're going to immediately start contributing value to your company. And as you get to know us and we get to know you, we're going to build an incredibly strong partnership so that when it comes time for us to put a term sheet together, or to your question, partner with a generalist VC for us to invest as a syndicate, it's going to be obvious. You want us in that mix. You mm-hmm. want us to lead the round. You want us to be on your board because we're driving value even before we had any skin in the game. Now we have skin in the game and this massive network to add value. So, and in the long term, it'll work itself out. It'll be better for our investors. It'll be better for our companies, and it'll make Camber Creek succeed. And over the past 10 years, that model's worked.
And it doesn't throw you off that a sort of a name brand investor is getting into the space or might be talking to the same companies. And it doesn't throw off the startup founders who are like, oh, wow, I could have Casey, or, Mark Andreessen wants to take my, I don't know if that sort of plays into it at all.
The space is so big. It is extremely positive for us. Mm-hmm. The most compelling thing that we've heard is it gives our Proptech space validation. It shows that it's not just a niche venture industry, that it's a massive category. People had talked about how big fintech is, and there's a good argument to say that real estate tech is an even bigger asset class mm-hmm. because of how big the real estate industry is. So we love that they're the generalist VCs who do 1 or 2 prop tech deals a year. That helps the whole ecosystem.
I saw this fascinating stat about Stripe, the fintech sort of leader, and the valuation of Stripe, which is what, 80 odd billion now, is larger than the entire fintech space was when Stripe started, right? That's the thing. So I'm curious about how this sort of TAM, total addressable market, is thrown around so much, but how do you sort of account for TAM growing exponentially as opposed to growing, incrementally?
Yeah. So I think one of the fun stats I like to share, when our first year, 2011, where we were investing in real estate tech, it's estimated less than $100 million was invested into the space. Mm-hmm. And I joke that we saw every deal. Mm-hmm. And in hindsight, to see every single deal when it's only $100 million wasn't that hard. Today, there's over $15 billion invested the past 3 years. And we expect that to continue to grow. And to your point about Stripe and fintech, mm-hmm. there's going to be, over the next 2, 3, 4, 5 years, just a massive amount of enterprise value unlocked. And your question around total addressable market. In 2011, real estate owners and operators had to be educated as to what real estate tech was first, mm-hmm. then why they should buy it, and then finally, how it actually saved them money or made them more money with their real estate.
Yep.
The total addressable market was tiny because people just didn't even know in the real estate space how much opportunity there was for their core business. Today, that's changed dramatically. The market is just so much bigger. You could argue that it became addressable before. It wasn't educated enough to be addressed. And now it is addressable. And when we have conversations with real estate groups, they know what Proptech is. They know they should be doing it, but we're still at the phase where they don't know where they should be looking. Yeah, I mean, we've needed attention and we're now getting it. This, when I say we, this sector. And when the public markets, it's the most like, there's something called the availability heuristic. And when the public markets put a lot of money into something, it becomes available to the largest quantity of retail investors. It brings attention to real estate tech. It brings attention to prop tech. And that attention will drive more exceptional founders to create great companies. It'll drive, a consolidation of top talent. FinTech.
We only have a couple of minutes left, so I want to get into just two last questions. One is, it's very nice to have tech that makes life a little bit easier for tenants and more sort of interesting and maybe saves on OpEx here and there. But where's the tech solving the wicked problems like sea level sort of rise? Where's the tech solving really the housing shortage? Where is sort of the tech solving these big problems that are fundamental not only to the real estate market, but really to our cities, to the overall economy, to the planet? Why isn't that really much of a space being talked about so far?
Yeah, so the largest challenge with that is there's no silver bullet. You can't say like, we're going to decrease the cost of construction by 90%. Therefore, we can build a massive stock of homes and people can have the American dream of being a homeowner. There isn't a silver bullet to say, here is the answer to housing, prices going up and we're going to invest in it. There are a ton of step changes that are happening that together are creating this massive change. And over time, I absolutely think real estate tech and our industries is doing that. So, I mean, going back to your question, let's just pick climate change. Measurable is step one, measure, track. Step two, change the entire buying process to facilitate how you buy. And more importantly, the transparency. Most people don't even have any clue what power they're buying. They just buy power. Could become from coal, solar, wind. They have no clue. They don't, a lot of cases, they don't even know they have the option. So by adding transparency to the power procurement, you're going to get a massive change. And then you could get extremely granular where you're actually changing the consumption behaviors at buildings. That's one example. And then like the housing stock question. With modular building, we've seen a lot of money invested into this space. SoftBank has been one of the
and a lot of that, Casey, did not work, right? Like we're talking about Katerra, I'm assuming, but like a lot of that did not work. And
the way we view it is not necessarily that it didn't necessarily fail. A lot of people are going to lose money. And the biggest challenge we saw is a difference between the type of capital and the type of growth of a company. And
break that down. That's interesting. Break that down.
Yeah. So with venture capital, your expectation is hyper growth, greater than 100% growth per year. With a company that does, let's just like pick on Katerra for a second, modular home building, it is incredibly hard to grow at 100% per year when you have such a capital intensive business. And that's not to say that their business isn't better, isn't more efficient, doesn't use fewer resources. It does all of those things. It is faster, it uses fewer resources, and the margins can be better than traditional consumption. And we've seen all three of those being true at a lot of different modular home building companies. The biggest challenge is venture capital the right type of financing? And to date, a lot of these companies have brought on venture capital financing and have failed to, what you said earlier, to get the returns that they need with that type of funding. So the way and the challenge that we see is matching the right type of capital with the step changes that are happening to make the world a better place, to get rid of the wicked problems we have,